If everybody can take their seats, Mr. Fate has deputized me to kick off the afternoon session. I'm Jack Ewing, correspondent for the New York Times here in Frankfurt. And our first speaker guest is Anshu Jain. Anshu, if I can invite you up onto the stage. I don't think I need to spend a lot of time introducing you. I think it's safe to say you're the most, with the possible exception of Mario Draghi, you're the most observed banker in Frankfurt. So I know everyone is going to be very interested to hear what you have to say. And just a word about the format, we're just going to do this as kind of an informal interview Q&A, and we're going to leave a little time at the end of the conversation for questions from the audience. So Anshu, thanks very much for being with us. Let's sort of get to the theme of this conference. Let me maybe just start by asking a very kind of broad question. What stage are we in the whole sort of continuum of recovery of the economy and the banking system? How close are we to the point when banks are going to be contributing to growth rather than being a drag on growth? What still needs to be done before we can start talking about a sort of normal European banking system, a system that's functioning reasonably well?
Well, first of all, Jack, let me just thank the organizers and everyone here to give me this opportunity to address all of you. It's an honor and a pleasure to be here. The question that you're asking, of course, is a critical question because the state of banks and the state of the European recovery are completely interlinked. So in order to answer your question, one has to remind everyone that in Europe, roughly 2/3 of the credit creation happens directly via bank lending. In the US, of course, that ratio is completely inverted. So as go the health of banks and lending, so goes European job creation. So your question is right at the heart of the overall state of affairs in Europe. So perhaps good news first. European banks are in far superior shape today than they've been at any point in the last 10 years. The numbers are clear. 20% reduction in risk-weighted assets. In the last 3 years alone, roughly a 4 trillion reduction in bank balance sheets. Simultaneously, 300 billion euros raised in equity issuance over that same period of time. So in very simple terms, a lot more capital, much shrunk balance sheets, much lower risk-weighted assets. And of course, that bodes well for the overall health of the European banking system. Nonetheless, when we take a look at the lending patterns, the picture is a little more nuanced. In the periphery, a 25% contraction in lending. In Northern Europe, roughly unchanged lending. So there's a big geographical difference. The spread between SME loans and large cap loans, and I believe you've had some stellar representatives from the DAX this morning. Well, certainly if you would have had SME representation, the picture would have been more gloomy. Average SME spreads have gone from 98 basis points to 135 basis points. So in simple terms, I would summarize my answer to your question by saying banks are in much better shape now than they were at any point since the crisis, but lending is still very impaired to somewhat impaired, depending on which sector we are talking about, in an economic bloc where bank lending is a key driver for credit creation.
Mm-hmm. So what needs to happen in order to sort of to get lending going again? Is it because the consolidation process is still going on? Is it the lack of demand? What's going to sort of break the logjam and get the credit flowing again?
Combination of factors. Partly, lending has shrunk because the appetite for borrowing has shrunk as well. And it's always very hard to figure out what the demand side equation of lending is versus the supply side equation. But I would posit the supply side is very much still a factor. Now, the ECB would hope that some of the liquidity provisions that they've put in place, the TLTRO and so on and so forth, should have got bank lending up and running. And indeed, in the first phase of the post-crisis period, that funding and that liquidity provision was critical. I would now tell you that that liquidity provision is having virtually no impact on net lending at all. So what's constraining the supply side equation? It's capital uncertainty. European banks still feel somewhat capital light. And in a world where many of them are trading at or near or sub book value, to be expanding their balance sheets at a time when there's still capital uncertainty, which could come from open question marks on the leverage ratio, open question marks on TLAC. So we still have some very important regulatory developments still to come ahead of us. But I would say the European banks are approaching the point where they can at least start considering stopping shrinking their balance sheet, which I wouldn't have said. In fact, I was here in front of this audience 2 years ago with a very different message.
And then I think that maybe a related question has to do with a topic that everyone's talking about now, which is quantitative easing. This is the ECB's attempt to sort of, I think, push that process forward. It's been going on for a week now. You've probably had a chance to observe it in markets. Is it going to do any good? What's your assessment after a week?
It's a complex question, and I think it deserves some careful analysis, because I wish I could have given you a pithy, glowingly positive short answer, but that would not be doing the complexity of the topic justice at all. So first of all, QE is of course having a profound impact. Let's observe that even though we knew that the program was going to be roughly €1 trillion, there's no new information there. The announcement of the program has had a profound impact on the euro. The euro is now down 18% on a trade-weighted basis, 25% against the dollar, and a large part of that move has come since the actual bond buying has started, which actually tells you that perhaps the market was not sure whether in fact the ECB was going to follow through and be able to implement or not. Equity markets have rallied very significantly. 7-year bonds, up to 7-year bonds have traded negative, and 10-year bonds are now trading at 25 basis points or below. So it's a very significant mover across all key financial markets in Europe. Its impact, I would say mixed. There's no doubt in my mind that this significant a move in the euro is going to have a profound impact on the export-led economies of Europe. And right here in Germany, our economy is 50% geared towards exports. You've had a near 30% move in the euro. That mathematics is not very hard to do. This is very good news for Germany. It's very good news for countries like Spain. Frankly, it would have been very good news for Greece if they'd stayed the course, because they have restructured their economy. It's more complex for economies like Italy, which, like the US, is a largely domestic economy. It does have an export sector, but it's not going to just come back to speed via a lower euro. So that's going to be more of a mixed story. The cost of QE could potentially be quite significant as well, and that's not something which we should forget. The impact on life insurance companies worries me. If you think in very simple terms, a life insurance company is also a form of a bank which takes money in promising very long-term fixed returns, and it has to buy assets which can beat those fixed long-term returns. Now, their accounting, fortunately, doesn't require them to mark to market on a daily basis. But if you think about what's happened, the replacement assets they're buying are at such low and such de minimis levels, it's very difficult to run that model the way they used to. I think it's going to be very challenging times for pension funds, very challenging time for savers in general. So we will create a class of people that will not benefit from QE. There's all the concerns which other markets have shown us about asset price imbalances, which we'll have to watch very closely. And frankly, for the banking sector, I would say QE is a mixed blessing, leaning towards a negative side. And if I give you a quick rundown of what that means for banking as well, let's run through it. On the positive side, lower LLPs, we're seeing it already. As interest rates drop, consumer finance, corporate borrowing, SME borrowing becomes very cheap. And so the ability for them to service debt increases substantially. We've already seen loan loss provisions peak in 2013 and now start to come down. So that's a very good thing. It's also going to be positive for banks which have got a diversified business model and operations outside Europe, because you'll have a positive translation on all of those earnings. Against that, it's bad news from a net interest margin standpoint, because your net margins on asset versus lending shrink. Loan to deposit ratios, which are high in Europe versus rest of the world, this isn't very good news for that either. So I think QE is a little bit of a mixed blessing from my vantage point. But then if you ask me the tougher question, which is, would Europe have been better off without it? I would have to say it's a necessary, if we want to keep the union, measures like these were required, but we have to watch the consequences very closely and make sure that the medicine does not produce side effects which wind up being a net negative.
Yeah.
Sorry, it's a very long answer, but I warned you.
It's a very good answer. And, well, I think maybe the point is, which we've seen throughout the Euro crisis, there's never an optimal solution to any problem. Everything that you do has positive and negative side effects. But let me go to another ECB-related topic, and that's the single supervisory mechanism. That's really a huge change in the way that banks are regulated. We had the comprehensive assessment, and the ECB has now been in charge of banks for, what, 5 months or so. What effect is that having? Do you see that as positive, negative, mixed?
Potentially a very powerful positive effect for Europe. First and foremost, it finally gives a common yardstick across Europe in terms of transparency of balance sheet, which was critical. At some point post-2008, European banks stopped trusting each other, and the provision of liquidity between banks in the so-called intra-bank funding market had gone to zero. So all these banks were coming straight to the ECB and procuring their liquidity. Banks were stopping, for all practical purposes, activities with each other, and that can be very negative in the long run. There were question marks raised about the quality of European bank balance sheets to begin with. So a comprehensive exercise which has scanned the balance sheets, performed a symmetrical stress test across all of them, and given a so-called health check can only be a very positive thing. You can now compare banks in Italy with banks in Spain, with banks in Germany, and so on and so forth, which I think creates the preconditions for transparency and trust. I have to say the AQR and the stress test exercise was very well coordinated, and here I would compliment the domestic home regulators as well very much. It was a very complex exercise, and for any of us, and there were a few in the room that have gone through it, not easy to have gone from a standing start to have completed the exercise that we did in 2014. The speed, the professionalism of everyone involved, you can take a lot of credit, and there was huge cooperation between the different regulators to get this done. So again, a big positive. It gives Europe a unified voice in the global debate around regulation. Prior to that, Europe had a fragmented 5 or 6 country participation process in the global creation of banking rules. Finally, we're going to get one voice. Obviously, a lot of work still needs to be done. The single resolution mechanism is not yet done. The single resolution fund is not yet in place. More needs to happen. But my final point would be the preconditions for European consolidation are now in place. You saw the headlines which talked about a Spanish bank now wanting to acquire a UK bank. Would we have seen that headline 2 years ago? Maybe not. So.
But your answer implies that the banks see the comprehensive assessment as being credible enough that it's restoring trust in banks. Banks are now able to trust each other in a way that they might not have been able to.
The data is definitely telling us that's the case. And it's not just banks with each other. I would have to think that partly the re-rating of European banks, which is taking place even as we speak. In the last 3 months, European banks have outperformed US banks for the first time, I believe, in a substantial manner since the crisis. And I think that has a lot to do. Of course, it has a lot to do with QE, but I think just QE without the SSM process, there would still have been a big lingering question mark about the quality of balance sheets. So I think it's played a big role.
Yeah. Okay.
But by no means would I be sanguine and say we're done. We are sort of a fifth of the way through what's going to be a 5-year journey before we really get to where we need to be.
Another topic that I know is dear to your heart, and also something that very important to Deutsche Bank, to the European economy in general, is investment banking. A number of your competitors, just the other day, Royal Bank of Scotland is basically getting out of investment banking. Barclays, some other banks have really pulled back. You're obviously a believer in investment banking. Convince the audience why that's not just good for bankers, but also good for the macro economy. What does it contribute to European growth?
Well, I think the best place to start would be when we talked about European growth. So, as we've said, 65 to 70% of credit creation in Europe is happening via banks, and banks have contracted lending 10% post the crisis. So In the US, by the way, that same bank lending market has grown by 4%, and it was only 1/3 of the total. So the logic is inescapable. If Europe is going to remain as dependent on unilateral bank lending as it has been, and we intend to take leverage ratios up, we intend to impose a tougher TLAC regime, recovery resolution comes in, I don't see European bank balance sheets expanding substantially anytime soon. We'll be lucky if we can stop the contraction. Now you tell me how we get European growth going again, and we create enough jobs for the young of Europe. Capital markets in Europe have to play a much bigger role than they have. Equity markets in the US are 3 times bigger than equity markets in Europe, even though the economy of the Eurozone is 2/3 the size. Securitization, SME securitization particularly. Here's a second thing which I think you'll find noteworthy. 2/3 of the job creation in Europe happens via SMEs. They're really important. SMEs don't get access very often to bilateral bank lending on the same terms. The whole securitization process was vital to keep SME lending going. So Europe has to lessen its dependence on bank lending, increase its participation in capital markets. Indeed, it's not surprising to me, and it's a very welcoming notion, that the EU has taken heed of this, and the Capital Markets Union is one of the important things which is now on the agenda. The Green Paper talks very much about reviving capital markets in Europe. If you think about what the ECB is trying to do, instead of buying sovereign debt in the QE process, wouldn't it have been really nice if we had a corporate bond market, an ABS market, a securitization market, where they could have bought the very instruments which will get the real economy going again. But there aren't enough of those instruments. So that's really the point I would make to you and to this audience, which is if Europe is going to grow, if Europe is going to be competitive, it needs a better balance between capital markets and bank lending. And certainly Deutsche Bank and other banks are vital to achieve that. And again, not to hit you with an unending barrage of numbers, but if we go back, some people say, that's fine. Why do we need European investment banks? We can get that from US investment banks. Yes, we can create yet another US monopoly. We have one in the internet, where the laws of the internet, the technology, is virtually a national monopoly. Do we want to create one in banking as well? We can do so. During the crisis, US bank lending in Germany shrank 30%. German bank lending stayed constant and then grew. So there's no doubt that domestic participation in a given sector tends to be different than just relying on global participation. So this is one where I think the facts speak against some of the emotion which has been generated on the topic.
Last question, then we'll open it up to the audience. And this also relates to the investment banking issue. Deutsche Bank aims to be a global bank. Again, what does Europe get out of that? If you're active in China and India and the United States, how does that benefit the European economy?
The last time I was asked this question, I was in Dusseldorf, and fortunately we had one of our top DAX clients in the first row who grabbed the mic and got up and answered that question before I could even begin tackling it. And he said, look, I'm in the process of creating a global, he has a global network already, but enhancing my global network, what do you want me to do? And I know one of our lead hosts today represents a top-notch US competitor that does a fine job. But his precise point was, if I want to buy a US company, do I only have to go to US firms to represent me? Germany is an export-led economy. It's back to the point I made earlier. 50% of German business is about doing business in other countries. Why would you want to have a domestic-only banking sector when your underlying economy is so profoundly global? And interestingly, on this point, by the way, as I travel and talk to regulators, as I talk to politicians in Berlin, there's very little debate. So I don't sense a great move to make Deutsche Bank an exclusively German institution. In fact, quite the contrary. I've yet to meet a single serious commentator that would suggest that.
Okay, we have a couple more minutes, so why don't we take a question, maybe two from the audience. Would anybody like to pose a question? Yes, sir.
Yes, Mr. Jain, Andreas Powell from American Chamber of Commerce. The subject of today is how to foster growth. We haven't yet discussed TTIP. Also, it is not affecting immediately the banking world, but how does it affect, in your view, the real economy, particularly the large caps and in particular also the midterm caps?
The TTIP process is incredibly important for Europe particularly, and frankly, if I can be parochial for a second, with the new level of dollar-euro. I think everything which can be done to promote trade, and particularly transatlantic trade, the US economy is going to grow somewhere between 2.5% and 3%. For now, the US seems to be happy tolerating a much stronger dollar. We'll see how long that lasts, but I see no signs right now that they're going to push back. Conditions are set up very, very well for us to have strong export-led growth fueling into that US recovery. Everything which can be done to promote that, I think, would be very positive. I wish financial services were part of the TTIP process because, frankly, and I don't want to get now specific, nor do I want to lobby, but for those organizations that have large US operations but are operating out of Europe, there's a profound asymmetry. There's US rules. I'm talking now about the IHC rule, which requires us to hold capital and create subsidiaries in the US, which is completely asymmetric because when their banks come here and do business, we don't require, and by the way, I wouldn't suggest that we should require them to do something similar. And I think TTIP would be of huge benefit to us, but I would be positive.
Is it going to get through? That seems to be the bigger question.
There's interest in both sides.
Anybody else have a question? Yes, sir.
Thank you. Alex Brazier with AICGS. My question goes to the link between QE and the issuance of ABS. Do you see a link? Do you see the possibility, given the scarcity of sovereign bonds in the secondary market, that might stimulate some more issuance of ABS in the coming months and years, or are these two things still completely separated? Thank you.
It's one of the most critical and understudied issues in European capital markets right now. Let's look at the way the US QE process worked. It was not done through devaluation of the dollar. It was done predominantly through two channels. The direct lending market via mortgages to residential real estate. It's well known that in the US, the wealth effect operates more through residential real estate than almost any other variable. And so by lowering the cost of a largely fixed rate mortgage market, they were able to jumpstart a mortgage market and a residential real estate market, which had been badly impacted by the financial crisis. And the second thing, of course, was through securitization, they were able to free up the provision of credit to small, medium, and large-sized corporates. We don't have either one of those mechanisms in Europe. We don't have a mortgage agency which buys mortgages and stores them in one place which can be conveniently bought. We rely on a bilateral bank lending market, which of course is going to suffer hugely through the whole leverage ratio debate, which is a separate point, but related. But it doesn't leave the ECB mortgages to buy, which otherwise would be a very natural place for them to go, because we have a multi-trillion, very safe, very conservative, full recourse, relatively low loan-to-value ratio mortgage market, which would be ripe for securitization, right? But we don't have the preconditions. And of course, in ABS, we've created a known goal. The fledgling ABS market in Europe, which was starting to grow, has been hit very hard by some of the new capital rules which have been put in place. And again, here I think the Capital Markets Union and the Green Paper, which I've only partially looked at so far, is a step in the right direction. Much more needs to happen. And there's a virtuous cycle which can be unleashed. So if we can get the ECB to step away from buying particularly peripheral sovereign debt, takes away the moral hazard issue, and channels this liquidity creation right into the sector which most needs it, which is direct lending to corporates. But we don't have it right now.
Anshu, I think we're out of time, but thank you very much for being with us and for your very interesting comments.
And again, I want to thank the organizers and the audience.
I'd like to invite Lord